You wake up on a Friday morning, grab your phone, and your silver investment is down 35%. Not 35 bucks, 35% in one single day. That exact thing just happened to millions of people. And if you think it was just the market being the market, hang on. The real story is way juicier than what you've heard on the news. By the time we're done here, you'll know exactly what crashed silver, why it really happened, and what it means for your money moving forward. Let's back up and set the scene because this drop was insane. Silver prices tanked harder and faster than they have since 1980. Gold got hit too, but silver got absolutely crushed. 1 minute it was sitting around $114 an ounce. Then, in less than 24 hours, it plunged to $72, bounced back to $84, dropped to $75 again, and just kept whipping around like a drunk piñata. We're talking swings that make a roller coaster feel tame. Gold wasn't immune either. It dropped from almost $5,400 an ounce down to $4,600 in a single session. Half a grand swing on something that's supposed to be the stable precious metal. Wild. If you turned on CNBC or scrolled any financial site, they gave you the quick, clean explanation. Trump nominated Kevin Warsh to be the new Fed chair, and the markets got spooked. Simple, right? New guy at the Fed. Investors freak out, sell their gold and silver. Done. Case closed. But hold up, that's only half the story. The real one starts here, and it's a lot more interesting. Picture you're at a poker table with your buddies. You've got a solid hand. You're feeling good. Then out of nowhere, the dealer goes, "New rule to stay in this hand, you have to triple your bet right now." No warning. Most people can't cover that. They're forced to fold, even with winning cards. The few who can afford it, they suddenly own the table. That's basically what happened in the silver market, except instead of poker chips, we're talking billions of dollars. And instead of a dealer, it's the big exchanges running the show. Here's how silver trading actually works, because this part is key. There are two ways to own silver. Way one, the old school way. You walk into a dealer or order online, hand over cash, and they give you real silver bars or coins. You stick it in your safe, and that's it. That's the physical market. Way two, the way big money plays. You buy paper silver, not actual metal, just a contract that says you have a claim to silver sometime in the future. Think of it like buying a gift card instead of the actual gift. The crazy part? In the paper market, you don't pay the full price up front. Say you want $100,000 worth of silver. You might only have to put down $10,000. The rest, the exchange loans it to you. That's leverage. It's like a financial megaphone. If silver goes up 10%, you don't make 10% on your $10,000. You make 10% on the full $100,000. So you double your money. Sweet, right? Until it isn't. The exchange that runs most of these contracts is called COMEX. They can change the rules whenever they feel like it. One morning, they can wake up and say, you know what, 10% margin isn't enough anymore. Now it's 30% or 40%, and you have to post it today. No debate, no warning. That's exactly what they did. COMEX jacked margin requirements up by 36% overnight. The Shanghai exchange in China raised theirs by 26% same day. So picture all those leveraged traders who were maxed out. Suddenly, they're told to triple their bet immediately. They don't have the cash sitting around. Their only move? Sell fast. When thousands of people are forced to sell at the exact same moment, the price doesn't just dip at traders. And the timing? Oh man, this is where it gets suspicious. This didn't happen on a quiet Tuesday. It happened on a Friday, right before Asian markets closed for the weekend. Asia is 12 hours ahead of New York, so they couldn't jump in to stabilize anything. Then get this, the London Metal Exchange, huge player in silver, had their entire system go offline that day. Just a technical glitch, I'm sure. And HSBC, one of the biggest short sellers in silver futures, their systems went down at the exact same time. Another coincidence, obviously. Meanwhile, in the US, news outlets started blasting a story that Trump was ending support for strategic metals. The Department of Energy later said, flat out, that report was false and deliberately misleading. But by then, the damage was done. Algos had already dumped billions in sell orders. Now here's the mind-blowing part most people miss. While the paper price was in free fall, the physical market was doing the complete opposite. In Australia, people were lined up around the block to buy real silver. In the US, one of the biggest precious metals dealers had their single biggest sales day ever, 2.5 times their previous record. Price crashing, demand exploding. How does that even happen? It's like concert tickets dropping to $10 while people are camping out for 3 days to buy them. It makes no sense unless the paper price and the real world price are completely disconnected. In China, physical silver was trading at a $10 premium over the paper price. In India, a 9% premium. People were happily paying way more for actual metal than the official price said it was worth. Why? Because the world is in a massive silver shortage. We're short about 200 million ounces every year. Demand outstrips supply. Over the last 5 years, that's added up to roughly 1 billion ounces missing. Silver isn't just for jewelry anymore. It's in solar panels, electric cars, AI data centers, smartphones, medical devices. The modern economy eats silver like crazy, and we're mining less than we need. You can't print more silver. You can't just make it. There's a finite amount in the ground, and digging it up takes years. So you've got this bizarre split paper market screaming crash, physical market screaming screaming, "We can't get enough." If you think this is new, let's rewind a bit. Back in 1980, the Hunt brothers tried to corner the silver market. Prices shot to $50 an ounce, insane back then. Exchanges changed the rules. In 2011, after the financial crisis, people lost faith in banks and piled into metals. Silver went from $18 to $49. Exchanges raised margin requirements 5 times in 2 weeks. Silver dropped almost 50%. Last December, silver hit $84. Exchanges raised margins twice during quiet holiday trading. Crash. Every time silver starts running hard, the same playbook: hike margins, flush out leveraged players, prices tank. It's like clockwork. So yeah, Kevin Warsh's nomination played a part. He's known as a hawk. Higher rates, less money printing. Markets thought maybe the dollar stays strong, so we don't need as much gold and silver insurance. That might explain a 5 to 10% dip, but 35% in a day? With margin hikes, system outages, fake news drops? Nah, Warsh was the spark. Someone else poured the gasoline. Who benefits from a crash like this? The big banks and institutions that were short silver. They get to close their losing bets at rock bottom prices. Perfect timing. Almost too perfect. One more thing that got buried in the noise. The same day as the crash, Trump announced a $12 billion critical minerals stockpile. And guess what just got added to the critical list? Silver. So the US government might start buying and storing huge amounts of physical silver in a market already short, right after prices just tanked. If you were planning to build a stockpile, wouldn't a fire sale price be convenient? What happens next? Short term? It could stay choppy for weeks or months. More volatility, maybe more margin games, maybe lower prices before it turns. But the fundamentals haven't budged. The world still needs silver for tech. The shortage is real. Physical demand is through the roof. The paper-physical disconnect is only getting wider. Look at past crashes in the 1980s. It took years to recover. In 2011, years. Last December, weeks. Why? Because demand is stronger than ever. This isn't a fear-driven bubble. The economy literally can't run without silver. So what should you do? First, if you're in precious metals, expect big swings. 30% moves are normal. If that freaks you out, maybe stick to something calmer. No shame in that. Second, think long-term. Don't try to nail the exact bottom. Don't use leverage. Don't risk money you need for rent. Third, if you're worried about the financial system, go physical over paper. That premium people are paying in China and India? That's a signal. Real metal in your hand is different from a promise on a screen. Fourth, diversify. Don't go all in on anything, even shiny stuff. Stocks, real estate, bonds, metals, a mix usually wins. And finally, keep learning. You're already ahead of most people just by digging into this. The more you understand the game, the less you'll panic when prices go nuts. At the end of the day, what we saw was a front row seat to how modern markets really work. The official story is always neat and tidy. Reality is messier, sometimes unfair, and rarely makes sense on the surface. But knowing how the game is played doesn't mean you have to sit out. It just means you play smarter. You spot fake moves versus real changes. You know paper isn't the same as physical. You know the TV explanation is usually missing half the picture. This silver crash in 2025 will be talked about for years. It was fast, it was brutal, and it showed some ugly cracks in the system. But it also handed opportunities to anyone who saw through the noise. Whether silver heads to $50 or $150 next, the key is making decisions based on facts, not fear. Strategy, not headlines. Your goals, not someone else's hype. The market's going to do what it does. You get to decide how you respond. If this helped clear things up, pass it along to someone who's still scratching their head. And remember, the smartest investment you can make is in your own knowledge. Stay sharp out there.